that Bob DeMichael brought over after Bob had sold Lexington Capital and formed Strategy Asset Managers. And there is, I really could spend quite a bit of time about Bob Watson, but you may not know the name. And if you do know the name, you're one of the legacy Strategy Asset Managers clients. And Bob's name actually came up during the Rose Bowl with the Welfords coming out and visiting with us from Mobile, Alabama. But um, Colonel Bob Watson spent 38 years in the United States Air Force, and he retired as a colonel. And that type of commitment really kind of shapes the person and the discipline that Bob DeMichael, saw in him when he was working with him at Lexington Capital. There are several people that know that the name Lexington Capital, but it was a money management firm that Bob DeMichael ran, and that started the portfolio management of which then turned into Strategy Asset Managers when there was almost a rinse and repeat with Bob asking Colonel Bob Watson and Lee Grishon and Kerry Longson, who's with us, came over, and here we go. 2001 started, and Bob retained some of the people that he wanted most there, and Bob Watson was one of those. You should also know that Bob, after his military career, he spent time in the financial services industry, and coincidentally, he was in management at Dean Witter. And why is that important? Is because my father spent 40 years at Dean Witter. He was also in management and was an executive during the time that Bob was in the Fort Worth, Dallas area. And my father's not here today, and neither is Bob to verify it. But I'm sure they knew each other because my father was the head of the national sales division, would come down and meet with the Dallas Fort Worth offices, and Bob was there. And I know that there was a strong relationship between those who served. My father was in the Navy, Bob was in the Air Force. My father was only a lieutenant, and Colonel Bob obviously retired as a colonel from the Air Force. But the people that mattered the most to Bob DeMichael, the founder of Strategy Asset Managers, who I bought the firm from in 2017, really mattered to him. And it's a small world with the connection that I had indirectly with Bob, and hearing his name and honoring him today. And Bob did pass away recently after a battle with Alzheimer's, and he was preceded by his wife, who also had the terrible disease. But we want to say rest in peace to Bob. And one of the nicest things that I heard today when I was talking to Bob DeMichael, Bob said, Sam, Strategy Asset Managers would be a different company today without Bob's contributions and also Lee's, all of which, who benefited from the firm today through the efforts of client retention and relationship management and business development. And if we didn't have Colonel Bob and Lee and Bob's leaders, Bob DeMichael's leadership back then, we would not be where we are today. And I'm proud to say that the firm is right at that $1 billion in assets under management. It's a huge milestone for us. I'm very proud of our team and what we've continued on with the excellent 13, 14 people that we have at Strategy Asset Managers, led by Joe Traba as the Chief Investment Officer, and Alex and myself. But once again, Colonel Bob Watson, thank you very much for what you did for Strategy Asset Managers in the country. And we look forward to the wonderful memories that we will share with the existing clients that you touched. We will now proceed into the market outlook. All right, so Joe Traba, Alex Hagstrom, and I wanted to share what we were thinking at the end of January and going into February. Joe has been successful at guiding the strategies with Alex's help and my oversight, and we did quite well in 2025. And we do think that the economy and well as the markets will have another positive year in 2026. As Joe shared, and I've been talking about on CNBC and Fox, um, uh, we are seeing a broadening of the market. We are definitely seeing the leadership shift, although the Mag 7 and some of the technology names that are prominently talked about, there's a broadening out, which is very healthy, and we're seeing Europe improve. And we will touch on several different areas. I'm going to turn it over to Joe, and although we had a very good year in 2025, we look forward to what our outlook is in 2026 and being very positive. So, Joe, we take it away.
All right, thank you, Tom. And as we always do, before we give out our 26 outlook, we like to just briefly review 25. In 2025, we did start off with some turbulence and volatility in the beginning of the year, March and April. But look back what we ended up at in December. We had a very nice gain for our markets. And what was surprising and a new development was the international markets. So the growth and performance we saw domestically was also overseas. We have a number of international markets making 52-week highs, all-time highs. That's very encouraging for the stock market. And that's something we talk about is the breadth. It's more stocks participating in performance. That's very encouraging. And when we get down to where we see pockets of strength and why is the stock market doing well, it goes back to earnings. And we'll kind of circle in on this, but I do want everyone to understand there's three pillars that are really driving not just the US stock market, but the global markets. And that's one, obviously, it's earnings growth. Companies are making more earnings, and we'll get into margins and things like that in a bit. But it's also you have fiscal support and you have monetary policy. So you put these three together, and it's a very powerful backdrop for the stock market. And then you add in AI or just technology and what is needed to come. And again, looking at the spending that's being done, and we've talked about this if you've been on our calls, the CapEx by the big hyperscalers or the big companies, that continues to grow. It's not going backwards, it's growing. And you look at the global catch up as well. So companies are continuing to spend, and that bodes well, not just for those companies, but you have to look at the secondary plays. And one of the biggest developments we've seen, and if you're a client of ours, as most of you are, we're overweight certain areas. And that's where we're seeing the growth. It's more not just technology, but the infrastructure. And that's a word we've talked a lot about, and I'm sure everyone's heard about it. It's the need for cheap power. If you need power, you obviously want to have the lowest cost, and that's global. And if you're able to produce lower power, you're able to increase manufacturing, and that just helps AI or technology. And as everyone's heard, for doing one click versus one chat GPT, it's 10 times the amount of power using chat GPT, 10 times the amount of power. So the amount of power needed in the United States and obviously overseas as well is just growing. And that's where we look for the secondary plays of what's happening. And going into that, we're just going to break it into three different trends. And then we're going to also share with you some of the risks that we're watching. Yes, we have a optimistic view for 2026, but there are things that can derail it. And that's the one thing we want to go over, both of them, so that you have a broad and a balanced view of the markets for this year. Now, we talked about earnings and the AI application. So what does that mean? Now you have a new technology. Now who's utilizing it? And one of the things I like to look at, and you've heard us say this before, is the Waymo. That's a driverless vehicle. If you've never been in one, I strongly encourage you to try it because this is the wave that's moving forward. And why I like to talk about it, because it's what's the number one job in the world? It's a driver. Now that driver can be replaced. And we're seeing that. But what's needed? You need to have the infrastructure and really think about this in basic terms. A road that has lines, stop signs, those types of basic guardrails are needed. And then you need to have the obviously the technology, and it needs to be able to be hooked up to the internet. So all these things come together, and that's what we look at for infrastructure. That continues to grow, and that's not just helping the tech sector, but it's helping the energy sector, industrials. These are areas that are broadening. And then again, financing it. So it's helping financials. We'll see the consumer come back in because you're increasing jobs, but it's also with the labor market, you're having a reduction in jobs. And that's helping companies with margins. So again, a robot works 24/7, doesn't need an HR. That's cheaper for a company as long as their power costs are low. So you have to look at those dynamics. Where's the positive and where's the negative from it? Now, we still talk about the Mag 8 and that are the best of breed as far as cash flow. We had Microsoft report this morning and the stock's trading lower. But if you really dig down into the numbers, it's astronomical of how much revenue this company makes and got a little maybe ahead of itself. We're still positive with Microsoft and what it's going toward. But you have to look at the big picture of really what's transpiring and where we continue to see growth. Now, with that is the energy independence. And this is where Alex is going to talk a little bit more about the cheap power and how this is just changing the world and how we not only grow, but also how our company's growing. Alex?
Yeah, so one of the biggest challenges right now has been the provision of electricity for data centers. And that's because a data center can be built in 1 to 2 years, but new electrical capacity takes much, much longer to bring online. And the fastest way to actually build new electrical capacity is through a natural gas power plant. But even those take around 5 years. But fortunately, America is extremely blessed with natural gas resources, some of the largest resources in the world. America is the largest liquefied natural gas exporter in the world. So if gas prices do become prohibitive here, we could always tamp down those exports in order to support the domestic markets. But right now, electricity prices are rising a lot because of data center demand. It is starting to become a political issue. And I think we can expect that eventually the large AI companies will be forced to take on part of that burden. But really, the long-term solution is hundreds of billions of dollars need to be invested into the US power grid to build natural gas plants, transmission capacity, eventually nuclear. And it's a very long-term theme that we're positioned to benefit from with a few companies.
Yeah, and when we go that, I just want to mention two things. Uh, Right now, the base case for the markets, and this is the Wall Street strategists, and some of them have a checkered past, but by and large, everyone is pretty optimistic for 26 for around a 10% gain, a little bit above that. So that is your base case scenario. And what we're giving is just reasons, some of reasons why we think the market can do that. The other part we mentioned was not just the energy, but when you look at monetary policy, and what does that mean? That means low interest rates, a little bit of why the dollar's doing, weaker relative to other currencies. And that's helped the global markets just by owning the same product, but in different currencies. That's helped globally by having a weaker dollar. It helps if you look at some of the companies that do business overseas, that's good for them. You do something cheaper here and you get a higher price with a higher currency elsewhere. But that does have effect on borrowers. It has low interest rates, so they're able to borrow at a cheaper rate, but it hurts income, people looking for income because you have a lower interest rate. And Alex, do you want to talk a little bit more about
Yeah, this
what
is
the
going to
Fed's doing?
be probably very contentious year on the interest rate front. We're going to get a new Federal Reserve chair in May, and whoever it is certainly going to be in favor of significantly lower rates. Right now, short-term rates are about 3.75%, but the president has said that he wants them at 1% or even lower. all of the candidates who have been put forth have been strongly in favor of getting rates down towards that 1% level. However, the Fed is actually a democratic institution in the sense that there are 12 voters and everyone gets an equal vote. So even though the Fed chair may want rates to be cut, it doesn't matter if the 11 other voters disagree or if even 7 of them disagree. So while we haven't seen a lot of dissent in the past amongst the Federal Reserve, I think we are going to see a lot of that this year when the new Fed chair gets in place in May, starts trying to cut rates aggressively, and potentially the other governors might disagree with it. And the current Fed chair, Jerome Powell, although he loses his chairmanship in May, he does have the option to stay on as one of the 12 voters for a while longer if he does want to sort of fight against Trump, I guess you could say, fight against the desire to lower rates much closer to 1. But that is what the administration wants, and that's going to be something that they try to pursue this year. The market does not think they'll get it, though. The market only thinks there will be about 0.5% of cuts in 2026.
Yeah, and that's important. So when we talk about potentially losing Fed Chair Powell, he could still stay on. And again, it's important to note there's 12 votes, and I think that's for us as a country, it is democratic and it is a vote. What we do see also with not just interest rates, but the reemergence of a weaker dollar. And that is a big reason why a lot of the international markets outperformed our markets because of the currency. Now, when we look at that, the dollar, a lot's been talked about, is it still the safe haven? And when we look at money flows, it's still the safe haven. But you're seeing the rise of gold or precious metals, potentially rising. And one reason could be the weakness in the US dollar. So, you look at these things and is it transformative, or is this just kind of a hedge? So those are things that will follow. We still think the dollar, right now is serving a purpose for the administration, but we could see that uptick, in the future. But right now, when we also not just talking about monetary policy, but fiscal policy. And what does fiscal stimulus mean? That just means, is the government spending? And Alex, is the government continuing to spend?
Yeah, I think, Democrats and Republicans agree very strongly about that, if nothing else, that, borrowing and spending, it has been the policy of both parties regardless for decades. And we do have midterms coming up, but whatever happens in the midterms, it's going to be a government that wants to borrow money and spend it.
Yeah, and also when we talk about what's happening in the US, this is nothing new internationally. We just had 3 central banks around the world all hold interest rates where they're at. You also had fiscal stimulus, and we look at defense spending. That's been a lot talked about of recent events, but you're seeing an enormous amount of money being spent in this industry. And it's not just the United States. It's not just China. It's not just NATO or Europe, but now we're also seeing Japan. Japan is on the verge of becoming the 3rd largest deficit to GDP for defense spending. So that's an area, when you look at where do we want to invest in, we want to make sure we have investments in industrials. That's the sector that holds defense, and that's the sector that holds a lot of for the manufacturing infrastructure. So if you're looking at our clients, that's one area. When we get into allocation and portfolio construction, that's an area that we are positive with. And again, it's trying to keep it simple. If you're seeing money flowing into that area, that's usually a good investment to have. The other parts of fiscal stimulus are not only spending, but also are they able to tax? We're not seeing any talk about raising taxes. In fact, we're also seeing anyone on Social Security, you're getting an increase in Social Security starting this month. There's also talk about a potential direct payment to households. Now we're unclear of who qualifies for that, but that's something that is being talked about. All of these are stimulant, whether it's short-term or long-term, that can be debate, but it's an administration that is pro-business, and that's where we're seeing the spending going toward, and again, running a deficit. And as we look at what happened with the US, again, I'm going to harp on the global because we're starting to see potentially more pro-business administrations throughout the world. And in Europe, they're actually passing slowly legislation to improve margins for companies, meaning that you no longer have to have an employee, give them a severance of 2 years. It's been dialed back. And there's actually now, a little bit of, there's still pushback, but there's more optimism that something like that might continue to get pushed through. And that might be because of the tariffs and some of the rhetoric that's going around. But I do want you to know the changing landscape that's happening globally. And when we get into the global, are the geopolitics or geopolicies that we need to be, concerned about? Yes. Are there always? Yes. And does the market continue to, you hear the headline news and then what happens? It usually gets dialed back and then the market continues to do well. That is something that we are paying attention to, but I don't get, nervous just because of a headline. And again, we're trying to give you a more balanced view of the positives and also the negatives and what this means for the stock market. And biggest thing we say is don't get emotional. And as we look at how the markets have performed in 25, just because we flip the calendar doesn't mean it has to change for 26. If we still have the pillars for the markets to do well, they're still in place. Now, what we've seen so far is some of the big mega caps, little cooling off. Started to see a little bit of that last year, but on the earnings, it's still dominant for the earnings growth by those companies. But if you look at the next wave of innovation, as far as application goes, that's enormous. And we're going to hear more IPOs coming out this year. So that kind of goes into the financial conditions for the financial markets, which remain healthy. And that's also something that we should be aware of. As long as we have employment levels where they're at, you don't get deep recessions. And as long as you get the financial markets acting well, we're not seeing any dislocations. So those are things that we really try to pay attention to. There are margins that are high, meaning margin debt or people borrowing. That always has to be viewed, but we're not seeing any meaningful upticks yet. So that's the view that we're seeing. And as Tom always likes, to talk about, have something to look forward to. And for us, it's not just the stock market that we've seen, good growth in, but it's also kind of think of on a global scale, what is happening this year? We're going to see NASA go to the moon for a first mission in, I think, over 50 years, and they're going to orbit about 10 days. That's something that's for me, it's nice to see. And we're going to get a front row seat of that. But we also have the Olympics. That kicks off February 6th, so less, about a week away. And we're going to have the Olympics in Italy. We also have the World Cup coming to California and also Mexico and Canada. So these are things on a global scale where you hear the negative parts, but this is a time when all the world leaders come together and you have a rallying cry to either support their team. These are good things to look forward to. And when we look at what's, kind of the headline news that's out there, we understand that's their job is to sensationalize and really sell the negative parts. But we also want to balance that up with a lot of the positives that are out there. You are getting people going to Italy to watch the Olympics. You are going to have a ton of people. If you look at the ticket sales for World Cup initially, huge demand. And those have positive effects, not just for the economy, but I think for our well-being. As it gets to the stock market, again, you've heard us say we continue to remain optimistic. It's the backdrop, just very constructive with supporting economic growth. We're seeing earnings momentum. We didn't even touch on this, but this year we're expecting double-digit earnings growth, and also for 2027. I have to start getting used to saying 2027, but we're starting to see earnings growth come through for that. And when we look at the forecast, and this is a heavy week of earnings, we get Apple after the close, and this is kind of a multinational that you need to know what's going on, is what we're seeing. So these are a good positive backdrop for growth to remain, but it's also when you look at the risks that are out there. And not that I'm a contrarian, but we hear a lot of the negatives out there. And when I get more negative, it's when we hear all the positives out there. So I don't think we're there yet. And that gets us, optimistic for global growth and also making sure you have proper diversification. And really to kind of keep it simple and look at the overall themes on what this market's doing. Low interest rates, favorable administration, and you have earnings momentum driven by AI. That's a powerful elixir.
Joe, let me jump in and just ask you some specific questions about the long-term themes that we see in some of the stocks that are reporting this week. We know that Microsoft, NVIDIA, Meta, ABB, Lockheed Martin, Waste Management, Honeywell, those are all positions that we own, and they're in queue. What do you think about the growth in the let's just talk about the tech sector right now, and then we're going to go into energy, and then we're going to go into infrastructure.
Yeah, it's just Microsoft would just kind of consider them the bellwether and the diversification in it. And if everyone needs a little refresher, Microsoft is not just the software company. Um, they also bought LinkedIn. They also have Azure, which is the cloud where you store everything. It's so many different moving parts, and their revenue and margins are still very healthy. But we did see is just the growth kind of decelerating. So it's still growing, just not at the clip that they did before. And the reason why they're restricted by some of their own internal systems, meaning they need to grow, they need to spend more money so they can meet demand. And really think about that. They're being restrictive by their operating systems. So they don't have the capability to grow faster. They have demand, but not the ability to grow faster. And that may take a few quarters for them, really for the Azure to grow. Those are good problems. It just takes some time. It doesn't mean it's slowing down. It's still huge demand. And that's where we kind of look at the overall big picture.
Yeah, so capital expenditures are still improving in that area or continuing. You talked about NVIDIA, Microsoft, and Amazon investing $60 billion in OpenAI, and the capital expenditure for the major technology companies is still exceeding expectations and will continue on. Eventually, that will have to stop, though. They can't just spend, but maybe Alex can make a comment on that. We've seen the charts about the capital expenditures and what this means for the market and the business cycle that we're in right now.
Yeah, so they expect to do, I think, in total, the big four, about $1 trillion over the next 4 years. Once that's done, there shouldn't be too much more need. They should have most of that AI infrastructure built out at that point. It is, of course, very positive for earnings because whenever a company does capital expenditures, they're giving revenues and profits to NVIDIA, to other companies like that, and that's very positive to earnings at the index level.
Good. And then we want to also touch base on the on liquid natural gas, energy, power, some of the companies that we own in that sector, the energy sector, that have been real strong winners for Joe and the portfolio. We've had success with Constellation Energy Group. Uh, Joe, you want to talk about a little bit of the companies that we follow in that area?
Yeah, and one of them that reported this morning was ABNY. It's a Swiss company and not widely, known about, but they used to kind of do the robotic arms. They sold that. Now it's more electric transmission. And that's the big feed going forward. It's not just domestic, it's international. But like Alex said, you have to think of the whole infrastructure, your electric grid, how you get power in and how do you get it fast.
Right.
Those companies are spending, it's a lot of money getting spent there. It's not just the data centers, so that's a big key area that's doing well.
Yeah. One of the legacy portfolio positions that Bob DeMichael had was Honeywell, and or we've owned for a long time. That beat. with 5 cents and missed on revenues. But what's the guidance there in the
Yeah, and
aerospace
Honeywell's
industry?
definitely changed, and you have to. This is one thing you have to adapt. And Honeywell's done a couple of spin-offs and splitting later this year. So it's kind of like a GE where they just got so big, and then you start cutting off into different components. Um, but what we're seeing, it's not just defense, and I think that's the point that needs to be made.
Correct.
It's transforming into other areas of the market where Honeywell kind of makes a little bit of everything, but it's production, it's manufacturing. And in order to have manufacturing stay in the US or come back to the US, you need to have cheap power. So those are multi-year themes that are going to happen. And that's a joint venture with the private public sector where you might have a desert and they're going to build, new homes, but you need a factory there. And the factories wants guarantees that they'll be able to have a power price for electricity. So that's what you have to think about and where we're going.
Yeah. Well, we've been fortunate with the direction of the themes that you brought up today, and the one thing that I've talked about and you and I talk about, it's what you own and what you don't own, and you might want to make a comment about that, Joe.
Yeah,
It's important what you own and what you don't own.
yeah, and that's I think really been prevalent with some of the sectors and as far as healthcare goes, that is a sector that's come under scrutiny for pricing, and pricing means lower margin for those companies. So if you're going to a certain industry that is having margins compressed, that's not going to be well for their companies, and that means it could be good for us because it might lower prices. And if anyone pays attention to what they're paying for healthcare insurance, you did not get a lower, cheaper price for healthcare for 26. It's still growing double digits. And I think that is an area the administration is trying to, help with lower profits, meaning cheaper prices for the consumer, such as us. And we've heard from a couple of the insurers this week, which we do not own, and they were down almost 20%. And a little bit of that is with the earnings guidance, but it's also Medicare, and they're not increasing the reimbursement rates. So they're keeping very thin margins. And I do think that's important. It's as we get into this world of just buying an indice, it's important to be underweight and overweight certain places. Thank you,
Yeah,
Tom.
yeah. And let's start to wrap it up, but and go back to the predictable and what typically happens when a Fed chair retires or leaves. And the only thing that's really predictable is we know the date that the announcement will happen, and the person steps down. That's the only thing we know. And whether it's Hass or Warsh BlackRock's, bond guy, Riddell, or it's really interesting to see, the opinions on who should be there, and then what Jerome Powell is going to do. And if I were Jerome Powell, I would sail off into the sunset and go to the private sector and make a lot of money, write books, and not want to be anywhere near the the noise, the drama, and everything that is included in that in the administration. But that's just me. He's,
You brought up two good points. One, if you're successful, why would you want to become a politician?
yeah,
But number two, it's the midterm elections coming up.
yeah,
And Alex, we were looking at the odds. Do you want to go over the Senate and House?
Yeah, so right now, Democrats are strongly favored to take the House, about 80% on prediction websites, and Republicans are favored to take the Senate at about a 67% chance.
yeah. All that over the period of time that I've been running strategy asset managers, and before that, and what Joe and I have always talked about, and even before, it makes no difference, honestly, about the politics. But the policies are very, very important, and I would lay money on that the economic engine that the United States is going through right now with the business cycle will continue on, and it would be a huge mistake if it got disrupted, because the leadership has shifted back to the U.S. on innovation and semblance and continuing growth from this malaise that happened over the last decade. I just think that the politics aren't going to matter too much. Just the pro growth is what we need, and the globe needs to expand that way as well. Joe?
Yeah, I mean, you need to have a balanced view, and again, I think the best decisions are made by the most diverse group you have, as long as they're able to speak their opinion. And that's what our country's founded on. So I want to hear people, disagree. You should be able to. We're not saying that shouldn't be the cause, but you need to have a solution. And that's when I go back to our politicians, come up with solutions. That's what you're there for.
Yeah.
So we hope for that to happen.
In closing, we want to say thank you again to all the people that are participating. And once again, rest in peace, Colonel Bob Watson. Um, I'm here today because of the contributions that you helped build the firm with Carrie Longson, who's with us, with Lee Grishon, and of course with Bob DeMichael, who graciously let me step into this role, which I'm so grateful for, and especially because how well the firm is doing with all the clients supporting us. But really, you don't want to forget where you came from. And Colonel Bob Watson was a true patriot, but also a leader in so many different regards. Um, let's sign off with that. So. Thank you very much for joining us, everybody.